Welcome to SBA University, lesson number 2, cash flow. Cash flow is king. In this video, we're going to look at the 5 things you should know in regards to cash flow and how it's going to impact the ability for your acquisition request to get approved by a bank. So first, let's talk about what is cash flow and how it can make or break your acquisition request. So cash flow is going to be the money available to pay back that SBA loan that you're about to take on to buy the business. It's really important that you dig into the numbers in the broker listing. They're usually going to do the math for you. They're going to show how much profit the business showed on the tax return, and then they're going to include all the add backs, all the unnecessary items that the current owner spent that they think will be available for when you buy the business. So when you're looking at cash flow, keep in mind, there's the ones that we always take. Think about the interest expense, because obviously there won't be any debt after you buy the business. It'll all be paid off. Think about depreciation. Think about any owner's salary that might not be needed when you take over the business. Or think about family members, right? The owner that might have a wife or a child or a cousin on the business making money that won't be there once you buy the business. Those are all things that we typically are okay adding back. Now, there'll be some other items. Think about personal expenses. So that auto expense. There might be meals, entertainment, travel. Most lenders will try to stay away from doing those add backs because they're kind of considered frivolous and they're harder to document. The SBA program is all about documentation. So with these add backs, keep in mind we'll need documentation to support it. So let's talk about the listing. When you get it, you'll see a number. It's usually attached to the SDE, the Seller Discretionary Earnings. So like I mentioned, the broker has kind of done the math for you. So it's really important to dig into those numbers. How did they get to that valuation? Most businesses are usually priced between a 3 to 4 times multiple to see what that purchase price is and see what that SDE number the broker came up with. So when you're looking at that listing, not only look at last year, but we typically will look at 3 years. So right now, currently, we're going to look at 2021, 2022, and 2023, right? You're going to want to see what kind of consistency there is, right? Always looking at top line revenue, looking at profitability. Has it been pretty stable? Has revenue gone up? Has profitability gone down? Really focusing on the most recent years. We're really going to focus on what happened in 2023. And don't forget how important year-to-date cash flow is as well. The most accurate representation of your business is really what's happening right now. So let's take a period of time like we are right now, right toward the end of the year. So we have almost a full year worth of financials that we can look at. What we want to do is make sure that it is trending similar to, hopefully greater than what happened last year. So when looking at cash flow, remember, it's not just a last year thing. It is a 3-year look historically. It is a current year that we're looking at this year. And what best represents the business is obviously what happened last year and what's happening right now. And let me focus on the add back piece because it can vary greatly depending on the lender you're working with, how they'll look at add backs. So I mentioned kind of the personal add backs, right? So let's take an example. Let's say the owner had a vehicle, and let's say that vehicle was $2,000 a month and it had nothing to do with the business. Now you can make the case that, hey, that's $24,000 a year that actually had no impact on the business. So could we consider that as an add back? Potentially, yes. Again, we would need the documentation. Think of a bank statement, auto loan statement, provide that. And then it's up to me, the banker, to kind of put that together and make the case as to why that vehicle is not important to the business. More than likely, it's not coming with the transaction. So potentially a personal expense add back. Now let's talk about one that I tend to see on a lot of different deals. Let's say meals, travel. So throughout the year, the owner bought himself lunch every day, and it added up to $10,000 a year in lunch add backs. They could look at that as, hey, this lunch, you're not going to have to pay $10,000 a year in lunch add backs. But again, here's the problem: documentation. Do you think the bank is really going to want to see $10,000 worth of lunch receipts? I mean, absolutely not, right? So it's items like that we typically will not consider. That, travel, somebody that took their whole family to Hawaii. Again, is it a true add back? I guess you could look at it that way, but that was an expense that they wrote off on the business. The one thing you got to remember is that the SBA program is a government program funded by taxpayer dollars. So they're not going to look too kindly on some of these add backs that might be considered personal that ran through the business. So you got to be careful on those listings that have excessive personal add backs. Now let's talk about how you, the buyer, impacts cash flow, right? Because buyer A and buyer B for the same business can actually have 2 completely different calculations from cash flow. The number one impact on that is typically whether or not you need to draw a salary from the business. Now, one thing you'll notice when you're looking at a business listing is there'll always be the owner's compensation add back. So if the current owner paid themselves $150,000 a year, then the broker will typically always add $150,000 to help boost cash flow, to help boost the seller discretionary earnings, which ultimately boosts the valuation, which is totally acceptable. But here's the thing. Buyer A might be quitting his job to run that business. Buyer B might have outside income or have a spouse that has sufficient income. Because what the bank's going to do is they're going to do an adjustment. So let's take that buyer A. Buyer A, quitting job, buying the business. Okay, well, buyer A's got a mortgage. Buyer A has a car loan. Buyer A might have some credit card debt. And so what we're going to try to do is factor what buyer A needs from a salary standpoint. And so what most lenders will do is typically look at annual fixed debt expenses. And let me give you an example. So if he has a mortgage, let's say on an annual basis costs $40,000 a year in debt payments. And let's say he's got one car loan, $10,000 a year in debt payments. So collectively, $50,000 a year in annual debt payments. Well, a bank might say, well, based on that, let's double that. He probably needs to take $100,000 a year salary to obviously pay for his bills and live. So the lender will then go to the owner's salary add back on the broker listing. And instead of the $150,000 current owner salary add back, we might only do a $50,000 add back, for example. So that would reduce your cash flow by $100,000. Whereas buyer B has outside income or a spouse that has sufficient income that can cover all their debts, we can do a full add back on that owner's salary. Now, some banks might do a percentage add back, and that's typically acceptable because if you think about it as the new owner, you should be able to take some salary. I mean, this is going to be an active ownership, right? So the idea is that you should take some money out for your work. So remember that. That is a key detail in this transaction, understanding whether or not you're going to need to take a salary from this business. And it's not the, I would like to have salary, it's what the bank considers what you have to take to live. That's really important. So that's a calculation that we typically would do on our end, but just keep that in mind as you're looking for businesses and you see what that owner's salary. And a lot of times you'll actually notice that the owner didn't take any salary. And now that's obviously going to directly impact the cash flow calculation if you have to take a salary. So a very key detail I usually like to go over with anybody that actually is looking for a business, that owner's salary category is really important when it comes to determining whether or not the cash flow is going to work. And the last thing I want to discuss today, which might be the most important, you may or may not have heard of this term, but this is kind of the holy grail of banking terms when it comes to approving loans. It's the debt service coverage ratio, the DSCR. Now, this calculation typically is what's going to determine whether a loan is going to get approved or declined. So what is the DSCR? It's a calculation that includes figuring out how much cash flow is available dependent on that specific situation, because like I mentioned before, that calculation can be different depending on who the buyer is. So what it's going to be is what we consider the total cash flow available to service the SBA loan. So let me give you an example of this. So let's assume the business puts out $150,000 of cash flow. And let's say the debt for the business that you're looking to buy, the SBA loan, I should say, is $100,000 a year in payments. As you notice, we like to annualize everything out. So if you have $150,000 of cash flow to support $100,000 of debt, the DSCR in that scenario is 1.5. 150 divided by 100. Now, the debt service coverage ratio can vary from lender to lender. Any lender is able to set its own minimum requirement for debt service coverage ratio. Now, obviously, the higher that ratio is, the better. That means you have more cash flow to service that debt. Now, remember, it's not just what it did last year. Most banks are going to look at a 3-year historical trend of what that debt service coverage ratio is. And then, of course, they're going to look at this year as well. For a really strong deal, they might want to have all 3 historical years pass and this year pass. Now, what passing means, again, will vary from bank to bank. I will say this, the most important time periods are always going to be what's happened recently and what's happening now. If that debt service coverage ratio is fantastic in 21 and 22, but it's gone down in 23 and it's gone down in 24, that might be a deal that will be difficult to get through credit. You know, the one thing that I always like to look at, obviously with the most recent years, is when a business owner is looking to sell their business, have they taken the foot off the gas, right? And sometimes you can see that reflected in the financials. Did revenue drop? How's business doing this year? One document that I usually recommend my borrowers to get is a year-over-year comparable. How is this year doing versus last year over the same time period? Because that tells a story right there. It tells me, is business still trending equal or above to last year, or has business dropped? And if business is dropped, that might be a red flag. Not saying that the business is failing, but it just might be a question. It might be a question to ask. I see business is a little bit down this year. Is there any specific reason why? So these are all important things to understand. But just remember that the debt service coverage ratio is going to be the ultimate thing that's going to get a deal approved. It doesn't matter how much experience you have. It doesn't matter how much money you have in the bank. If your deal does not pass that test, not getting approved. So again, just remember, cash flow is king. You impact the amount of cash flow that's going to be available to buy the business. It's important to look at the broker listing to see all the add backs that they included to get to that seller discretionary earnings. Remember, lots of personal add backs can be a red flag. Not saying it's going to be a deal breaker, just want to recognize if there's excessive personal add backs. And ultimately, that debt service coverage ratio is going to make or break your deal. I hope this lesson helped you better understand cash flow, how a lender looks at it, and how you impact it. Until next time, class dismissed. Thank you for watching this episode of SBA University. Hopefully you found this episode helpful. If you need to get a hold of me directly, I'll leave my email address down in the description. Be on the lookout as I will be releasing new lessons every week to help you in your SBA journey. Thanks.